Welcome back to the channel, where we break down the most important moves in the global financial markets. Today, we're talking about something truly historic. Gold has just done the unthinkable. For the first time ever, the world's most trusted safe haven asset has officially broken above $5,000 per ounce. Let that sink in. On January 26, 2026, global gold prices surged past the $5,000 level. During today's trading session, prices even spiked into the $5,100 to $5,126 range. This is a level that, until recently, existed only in the most aggressive long-term forecasts. So, the big question is, why is gold exploding right now? Today, we're focusing on one dominant force behind this rally: geopolitics. Let's zoom out and look at the global picture. Geopolitical tensions are rising across multiple fronts. We are not just talking about trade disputes between major economies. We are talking about strategic uncertainty, regional conflicts, and shifting global power dynamics. From renewed geopolitical flashpoints to aggressive foreign policy rhetoric, uncertainty is clearly rising, and uncertainty is exactly what financial markets fear the most. When uncertainty increases, capital looks for safety. Historically and consistently, that safety is gold. Gold does not rely on any government. Gold cannot be printed. Gold is not tied to political promises. Its value is globally recognized. That is why, when geopolitical risk increases, gold demand rises almost automatically. On January 26, gold posted a very strong bullish trading session. Analysts agree this rally was not driven by short-term speculation. Instead, it was driven by defensive capital flows. Investors were not buying gold for a quick trade. They were buying gold because they are worried about what comes next. They are worried about next week, next month, and the next geopolitical shock. Think of gold like insurance. You do not buy insurance hoping something bad happens. You buy insurance to protect yourself if something does happen. That is exactly how hedge funds, institutions, and central banks are treating gold today. The modern gold market is no longer driven only by jewelry or industrial demand. It is increasingly driven by investor psychology. Every escalation in global tension pushes investors towards safety. Every unexpected political move strengthens gold demand. This psychological factor is one of the strongest forces behind the current rally. Now let's turn our attention to the Federal Reserve. This week, all eyes are on Washington. The Federal Open Market Committee meeting is taking place. Markets are focused on one man, Fed Chairman Jerome Powell. The Fed is widely expected to keep interest rates unchanged. However, that is not what investors care about most. What truly matters is Powell's tone. Investors want to know if the Fed will stay hawkish or begin signaling a future pivot. Keeping interest rates high for too long risks slowing economic growth. When growth slows, the Fed historically changes direction. Gold is a non-yielding asset. When interest rates are high, holding gold has a higher opportunity cost. When rate cuts are expected, that situation reverses. Lower rates reduce the appeal of bonds and cash. Gold becomes more attractive as a store of value. That is why gold reacts so strongly to even small changes in Fed language. A dovish signal from Powell could push gold even higher. A hawkish surprise could trigger a short-term correction. Fed policy also directly impacts the US dollar. When the Fed becomes more accommodative, the dollar usually weakens. Since gold is priced in dollars, a weaker dollar makes gold cheaper for global buyers. This increases demand and supports higher prices. At the same time, de-dollarization is accelerating globally. Many central banks are increasing their gold reserves. They are diversifying away from reliance on the US dollar. A weaker dollar strengthens this trend even further. So what does all of this mean for investors? First, stay calm and stay informed. Fed weeks are often volatile and unpredictable. Emotional decisions during these periods can be costly. Second, understand gold's role in a portfolio. Gold is not just a trade. Gold is a risk management tool. Allocating a portion of assets to gold can help protect against market instability. Finally, focus on long-term cycles rather than short-term headlines. Short-term volatility matters less than long-term monetary and geopolitical trends. Gold breaking above $5,000 per ounce is more than a headline. It is a signal. It signals rising global risk and shifting monetary expectations. It also reflects declining confidence in fiat currencies. Geopolitics, Fed policy, and a weaker dollar combining into a perfect storm for gold. This analysis represents my personal opinion and is for educational purposes only. It is not financial advice. Please do your own research before making any investment decisions. If you found value in this video, please like, share, and subscribe to the channel. Thank you for watching. I'll see you again in the next video.